In Chapter 11, we will talk about responsibility accounting systems. What's decentralization? Decentralization involves delegating decision-making authority to lower-level managers of an organization. Why is it important to managerial accounting? Performance measurement is improved when we understand who is responsible for each decision made within a firm. We want to strike a balance between delegating authority to those most capable of making good decisions and ensuring cohesion in following through with firm-level objectives. A decentralized organization does not confine decision-making authority to a few top executives. Rather, decision-making authority is spread through the organization. Let's take a look at advantages of decentralization. It enables top management to concentrate on strategy, higher-level decision-making, and coordinating activities. It acknowledges that lower-level managers have more detailed information about local conditions that enable them to make better operational decisions. It enables lower-level managers to quickly respond to customers. It provides lower-level managers with the decision-making experience they will need when promoted to higher-level positions. It often increases motivation, resulting in increased job satisfaction and retention, as well as improved performance. There are some disadvantages of decentralization as well. Lower-level managers may make decisions without fully understanding the big picture. There may be a lack of coordination among autonomous managers. The balanced scorecard can help reduce this problem by communicating a company's strategy throughout the organization. We will talk about the balanced scorecard later. Lower-level managers may have objectives which differ from those of the entire organization. This problem can be reduced by designing performance evaluation systems that motivate managers to make decisions which are in the best interests of the company. It may be difficult to effectively spread innovative ideas in a strongly decentralized organization. This problem can be reduced through the effective use of intranet systems, which enable globally dispersed employees to electronically share ideas. Now let's take a look at the decentralization in the industry. A couple of key points. First, have different people working on different things. Let's say in Apple, some employees work in software department, some in hardware, some in product development. Second, trust the decisions made by other people and work as a team. Responsibility centers. Responsibility accounting systems link lower-level managers' decision-making authority with accountability for the outcomes of those decisions. The term responsibility center is used for any part of an organization whose manager has control over and is accountable for cost, profit, or investment. There are three types of responsibility centers: cost center, profit center, and investment center. Cost center. Cost center is a segment whose manager has control over costs, but not over revenues or investment funds. Accounting department, general administration, personnel, and manufacturing facilities, R&D department. These are normally classified as cost centers. For example, manager working in R&D department in Apple is mainly in charge of designing iPhones and laptops. He or she can control the cost by selecting the materials of the cases, CPUs to be included, and panel size. But the manager cannot control over revenues or investment funds. Standard cost and variance reports, which we've learned in Chapter 9 and 10, are often used to evaluate cost center performance. Profit center. Profit center is a segment whose manager has control over both costs and revenues, but no control over investment funds. Examples are Zara store in South Coast Plaza or Apple store in Spectrum. Let's say the manager in charge of the Apple store in Spectrum would be responsible for both the revenues and costs of the store, and also profits. Profit center managers are often evaluated by comparing actual profit to budgeted profit. Segment reports are used to evaluate their performance. Investment center. Investment center is a segment whose manager has control over costs, revenues, and investments in operating assets. For example, GM's VP of Manufacturing can make the decisions such as investments in equipment to produce more fuel-efficient engines. Apple's VP in North America can make decisions on investing more retail stores to increase profits. Investment center managers are often evaluated using return on investment, ROI, or residual income, RI. Now let's take a look at the accountability measures used to evaluate investment center. Learning Objective 1 is to compute return on investment, ROI, and show how changes in sales, expenses, and assets affect ROI. This is a formula to calculate return on investment, ROI. ROI is defined as net operating income divided by average operating assets. Net operating income is income before interest and taxes. Sometimes we refer to as earnings before interest and taxes, so you can see the term EBIT. Operating assets include cash, accounts receivable, inventory, plant and equipment, and other assets held for operating purposes. These are assets reported on the balance sheet for operation. To calculate average net operating assets, we use beginning balance of operating assets plus ending balance divided by 2. Most companies use the net book value over depreciable assets to calculate average operating assets. You've learned in intro financial class. For PPE, property, plant, and equipment, except land, all PPE should be depreciated. For net book value, it's calculated as a difference between acquisition cost or historical cost and accumulated depreciation. Based on this approach, the longer the company holds the asset, the lower the net book value of the asset, because accumulated depreciation increases. For the same acquisition cost, net book value will decrease. So, the denominator in ROI formula will be lower and ROI increases over time. But after asset has been fully depreciated, the company may purchase a new asset to replace it. Then ROI decreases because the denominator increases at once. For ROI, we can decompose ROI as 2 components, margin and turnover. For margin, we use net operating income divided by sales. And for turnover, sales divided by average operating assets. Sales will be cancelled out in ROI formula. So ROI equals margin times turnover. For margin, margin measures how much profit a company makes on $1 of sales after paying for variable costs of production, but before paying interest or tax. If the selling price increases, operating expenses decrease, then net operating income will increase and margin will also increase. Turnover. Turnover is calculated as dividing sales by average operating assets. It incorporates a crucial area of a manager's responsibility, the investment in operating assets. It suggests efficiency that the company can use the operating assets to generate sales. For all those three ratios, ROI, margin, or turnover, the higher the better. Let's take a look at example. Rico Company reports the following. Net operating income $30,000. Average operating assets $200,000. Sales $500,000 and operating expenses $470,000. What's Rico Company's ROI? Following the formula, we can calculate ROI directly. Net operating income $30,000 divided by average operating assets $200,000, and you will get 15%. We can also decompose ROI into margin and turnover. For margin, we use net operating income divided by sales, 30,000 divided by 500,000. Margin is 6%. For turnover, we use sales divided by average operating assets, 500,000 divided by 200,000, and we will get 2.5. Margin times turnover is ROI, 15%. And let's interpret turnover and margin. For turnover, 2.5, it means investing in $1 of operating assets, sales increase by $2.5. Margin 6%. It means of that $2.5 in sales, you keep 6%, which is 15 cents, as operating profit. And now, assume that the Rico's manager invests in a $30,000 piece of equipment, which increases sales by $35,000 while increasing operating expenses by $15,000. Let's calculate the new ROI. Sales increased by $35,000. Operating expenses increased by $15,000. So net operating income increases by $20,000. That's the difference between sales increase and operating expenses increase. So net operating income increases from $30,000 to $50,000. Average operating assets increased by $30,000 from $200,000 to $230,000. Sales increased from $500,000 to $535,000. Operating expenses from $470,000 to $485,000. Following the formula, we can directly calculate ROI. Net operating income divided by average operating assets. 50,000 divided by 230,000, and we can get 21.8%. If we decompose ROI into margin and turnover, ROI 50,000 divided by 535,000, and we will get 9.35%. And for turnover, 535,000 divided by 230,000, and we'll get 2.33. Compared to the original numbers, ROI increased, turnover decreased, but margin increased. It means the investment decreased the turnover. However, the increase in margin more than offset this decrease. So ROI still increased. There are some criticisms of ROI. First, just telling managers to increase ROI may not be enough. Managers may not know how to increase ROI in a way which is consistent with the company's strategy. For example, the company does not want to overproduce and sell Harley because the brand value may be reduced by mass production. Second, a manager who takes over a business segment typically inherits many committed costs over which the new manager has no control. This may make it difficult to evaluate a manager relative to other managers. Third, a manager who is evaluated based on ROI may reject investment opportunities, which are profitable for the whole company but would have a negative impact on the manager's performance evaluation.